Hello, everyone. Welcome back to our channel and welcome back to the Capital Insights Brief Update series. This series is within our Fundamentals Through the Noise series on Punjab Capital Research. And today we wanted to talk to you about the Breakeven Bridge. Saudi Arabia is lining up sale of stakes across its infrastructure empire, sulphur terminals, oil export terminals, real estate, water, in a program that could ultimately tap around $50 billion. The headline reads as portfolio housekeeping by a cash-rich major. However, it is better understood as a financing bridge. The world's lowest cost producer is monetizing the plumbing of the oil state because an inflated fiscal break-even has collided with the post-Hormuz supply glut. The sharpest feature is the timing. The ceasefire that unlocks the sale is the same event that reprices crude that Aramco intends to keep. So let's talk about the sale program out here. Reuters reporting this week put the running tally of Aramco's potential infrastructure fundraising at around $50 billion with stake in sulphur business, internally codenamed Project Yellowstone and capable of raising around $7 billion, the latest tranche to be rated. Banks are invited to pitch in May, a deal that would not launch before 2027. Taken in isolation, the sulphur sale looks like opportunism around a byproduct that the company already trades at scale. Now, the breadth and the sequencing say otherwise. Sulphur sits alongside the $11 billion Jafurah lease and leaseback already closed with the BlackRock and Global Infrastructure Partners Consortium. An oil export terminal package valued at up to $25 billion and slated for the second half of the year. A real estate portfolio including the headquarters campus at around $10 billion, water assets such as Project Hydro at roughly $500 million, and gas-fired power plants worth at least $4 billion flagged earlier. This is not a one-off. It's a staged multi-year monetization of the oil state's infrastructure, running as a standing financing channel rather than a single event. Let's also talk about a higher break-even producer who's repricing down. Now, the fiscal backdrop has already turned hard. Saudi Arabia ran a budget deficit of roughly 5.3% of the GDP in 2025. The first quarter of 2026 alone produced a shortfall of nearly $33.5 billion as the Hormuz shipping ceased and crude sales fell. The kingdom's budget break-even sits at approximately $108 per barrel, amongst the highest in Gulf, inflated further by wartime spending. Against that, Brent has slipped to around $78 per barrel, a 3-month low and down close to 40% from its conflict peak, with Goldman Sachs modeling at around $50 by the year end as regional supply returns. The highest break-even major producer is being asked to find its gas pivot precisely as its core product is being repriced downwards. Now, this is not a solvency story, obviously. Public debt at nearly 38% of GDP, a deep financial asset base, and established market give Riyadh ample room to run and finance deficits. This is exactly why the asset program reads as a deliberate choice, monetize stable infrastructure cash flows rather than over-issued debt into widening credit spreads. What is important to note out here is the direction of the signal. Deficits are structural, the break-even is elevated, crude is soft, and Aramco must simultaneously bankroll around $100 billion Jafurah build-out at the center of the kingdom's gas ambitions. The plumbing is being sold to defend the pivot out here. This brings us to the financial engineering with the state as an issuer. Now, the mechanism here is familiar. The Jafurah lease and leaseback is the template. Separate an asset's cash flows from its ownership through the structure that imports third-party capital while retaining operational control. Sulphur terminals, export terminals, and water assets replicate the same wrapper. Our viewers and readers of our work will recognize the DNA from wrapping the depreciation, the Apollo Blackstone financing of compute infrastructure, wherein the engineering monetized a stable, depreciating, cash-generative hard asset without surrendering any control of it. What has changed is the issuer out here. The structure that private operators use to finance data centers and platform infrastructure is now being applied to the sovereign slumbing at the heart of world's largest crude complex. The global infrastructure and private capital machine, the same force chasing duration and inflation-linked cash flows, is being handed the export terminals, processing trains, and storage of a petrol state. The asset stack financialization thesis, in other words, has reached the sovereign tier. For Saudi Arabia, this is a ceasefire that cuts both ways. Here is the feature that distinguishes this from an ordinary disposal program. Aramco is explicitly waiting for regional tensions to ease before launching the $25 billion oil terminal sale, likely in the second half of the year. The gating event is imminent. A US-Iran interim agreement is expected to be signed in Switzerland this particular Friday, resuming the Iranian exports, reopening the Strait of Hormuz, and releasing the 100 plus tankers stranded in the Gulf. That produces a reflexive loop. The same ceasefire that lets Aramco launch the terminal sale into a calmer market is the event that floods supply back, deepens an already forming glut, pushes crude lower, and widens the very deficit that the sales are meant to bridge. Aramco sends the plumbing into relief rally that undermines the product itself. Timed well, the post-ceasefire calm lifts the rapper's valuation. The same calm degrades the fiscal backdrop, forcing the sale. The trigger to monetize the infrastructure and the trigger to reprice the crude are one and the same. The event that lets them sell the terminals is the same event that cheapens the oil that those terminals carry. Let's wrap up with the bottom line out here. The 50 billion figure is financing and not the story. The high break-even producer is converting the infrastructure of the oil state into a standing capital channel to fund its gas pivot through a softer crude cycle and sequencing the largest tranche around a ceasefire that simultaneously reprices its core product. The break-even is the gap and the plumbing out here is the bridge. Now that's all that we wanted to share with you in this brief video update on the break-even bridge of Aramco selling the plumbing and Saudi Arabia building a bridge across the break-evens. Stay tuned in for our next update.